Well, last year's budget was really focused on shutting down what I would call creative tax planning, anything that Canada Revenue Agency looked at for what they would call abuse or working around the spirit of the legislation. That was last year's budget. They had about a dozen very specific changes in the budget that were intended for that. So we called it a loophole-busting budget. And this year, we still have a little bit of the legacy from last year's loophole-busting budget. And in particular, small business planners are going to want to look at three things from this year's budget. The first being the RCA trusts. If you work with clients or you have an RCA trust where you've used life insurance, and especially the levered life insurance strategies, that's all being shut down now. So they're not going to allow the use of an RCA trust for owner-managers in that application. So if that's something that you've been using, you want to look into that. Second thing is EPSBs. These are another trust vehicle that's been used mostly for owner-managers all across Canada to flow their salary and make it sort of escape Canada Pension Plan premiums. And in some places in Canada, they've used it as an income splitting tool. And so this year's budget says no longer will what's called a specified employee. So an employee who has a significant equity interest or they don't deal at arm's length from the employer, these specified employees cannot flow significant amounts through an EPSP trust. And they define that at 20%. If the EPSP allocation exceeds 20% of regular salary, it becomes subject to a whole bunch of tax, really basically the high marginal rate tax. So these rules come into effect March 29th, 2012, and they are going to dramatically shut down the use of EPSP trusts for owner-managers. And then finally, we have the group accident and savings plans, the GASPs. These have become a very popular planning tool to really have critical illness insurance premiums paid on a tax-deductible basis by the employer. And now they've redefined where a GASP will fit in a corporation, and they say, unless the premiums that are being paid through the GASP are used for a benefit payable on a periodic basis, then it won't achieve the tax benefits we've been getting. So really we want to say goodbye to CI policies paid for by the employer thanks to this year's budget. So those are the three things, the RCA, the EPSP, and the GASPs, all fairly significant changes. Sort of a sad day for some small business planning, but the good news is the IPPs are still rolling forward in 2012, and there's been no changes to the private health service plans.